Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone. Welcome back to another episode of On the Margin. Today, I am very lucky to be joined by repeat guest of the show, Bob Elliott, as well as Andy Constan. Guys, welcome to On the Margin.
Thanks very much.
Yeah, thanks for having me.
Very excited to have the two of you here. I didn't realize that you actually shared a desk or sat next to each other during your time at Bridgewater and your old friends. So my objective for this show is to stay out of the way as much as possible and just let the two of you riff. But maybe just to plant our opening salvo here, and we can start sort of broad, and I'd love to get your guys' thoughts. Bob, the last time you and I were chatting, it was with Cameron Dawson. We were talking about this scenario that many of you following this podcast will have heard, or is it going to be a hard landing or a soft landing or a no landing? And Bob, maybe I'd love to just sort of get a sense from the two of you at a high level about what your thoughts are on the possibility or how imminent a recession may or may not be. And Bob, I've sort of sensed your view changing a little bit over the last couple of months. So maybe I'll turn that over to you first.
Yeah, well, I think the first thing when you're trading markets, very important to start with what's priced in. It is often forgotten because it's so easy to sort of get a sense of that. But I think in this case, what we've seen is we've gone from a period where if you go back a year ago, right, particularly entering 2023, everyone thought that a recession was imminent, right? That was essentially what was being priced into markets. And that didn't happen. And there were not that many of us out there in the public domain who said that wasn't going to happen. We took a lot of heat from it. And we didn't get a recession. And that's for a variety of reasons that, we can maybe go into a little later, that the economy was a bit more resilient and had more momentum in it than what many people had suspected. I think the thing that's really changed and has been a meaningful shift is that kind of like everyone's given up on the recession view, right? If you look at stocks, they're pricing in 12% earnings growth in 2024. That's not consistent with a recession. I've seen a few recessions in my day, and double-digit earnings growth is not recessionary. And similarly, like actually the short rate market really isn't pricing in a recession. It's pricing in a moderation of inflation and the Fed responding to that by delivering 100 basis points of cuts. But it's definitely, unwound a lot of the sort of recessionary pricing that existed, particularly post SVB. And so we sort of have this circumstance where the expansion has become longer in the tooth. We're starting to see parts of the economy turn to get weaker, right? Whether it's employment or, probably housing on a forward-looking basis, or, certain areas of the economy you're starting to see weaken at a time when essentially everyone's gone all in on soft landing or no landing. And I think that's really the cruxy, interesting part of the market right now in terms of, as an investor, what's interesting in trading markets is fading that relatively extreme view that we're going to pretty much, no matter what, get a soft landing or no landing over the next 12 months. And the probability of that is, it's not zero, but it certainly is very, very far from 100%.
Yeah, so Bob and I came at this the same way in 9 months ago when I was on higher for longer island for basically by myself with a small contingent, including Bob, on a different.
I had a little hut on one of the beaches.
Yeah, I think the issue that Bob raised about pricing is the one that I think is the most interesting, which is. When I was, a year ago, 9 months ago, the cuts for even 2023 were priced into 2-year notes. And more relevantly, the cuts that were priced in for 2024 were about 160 basis points. And, that was sort of peak. And that is a 2-year note that is really expecting the economy to sour abruptly. And today, we ticked at 100 basis points a couple of, maybe it was sometime this week, where maybe it was 103 basis points of cuts priced into 2024. And that's where the dot plot, the summary of economic projections for 2024 is at this moment. So we're basically at, in pricing in the 2-year, exactly what the Fed thinks the path of interest rates are going to be. And that's for the first time. Now, I have a view, and we have the CPI number and the PPI number next week. And who knows what those will be.
Right.
My guess is they'll be a little warm because of, some of the factors that have been, particularly headline, but who knows what they'll be. But if they are strong or in line, the SEP gets repenciled at the FOMC meeting next week, or the week after, on the 20th. And I am fairly confident that the 560 terminal rate that is currently in the June dot plot is going to be the same, basically, maybe a few basis points higher, probably not lower, giving the Fed a chance to raise one more time if they want for 2023. And so at a 560, the question will be, do we stay at 460 in 2024? And I think that number's got to go up some for the Fed to say, hey, we are serious about the economy's stronger than we expect. We're serious about pausing for a long time. And so I'm expecting a number like 75 basis points. Maybe it's 60, maybe it's 80, but somewhere in that range for the cuts priced in. And that'll be an interesting thing to see. The CPI could leave it at 100 if it's cool, or we're going to 75 if it's weak. And it'll be interesting to see if the market will stay with the Fed and cause 2-year note yields to rise to 5.25 or 5.30. And that's what I'm looking forward in the very near term. But I think the bigger point is when you come back to that, the bond market now has negative term premiums on long-term bonds that are very low. And the front end of the curve is pretty boring right now in that very narrow way I've just described. But the equity market is still in a completely different outlook for growth and nominal GDP, let's say, in this 12%, not only for 2024 earnings growth, but also, and no one knows, but 2025 is also 11% GDP growth. And those are two big numbers when you have a 10-year note at 4.5 or 4.30. So I still don't think those markets line up well, but I would say that the front end of the curve, twos, are about right.
So, Andy, I'm just going to ask you, could you define, just for the audience, what term premia is and the significance of that when you mean, because I've got some more specific questions for you around it.
So to put it simply, every asset, by and large, every asset has risk. If you decide to invest in it, it could go up or it could go down tomorrow, whereas cash doesn't do that. And so if you are going to buy an asset, you are taking on risk and you deserve and are typically, in most environments, paid a return for somebody who wants your cash to consume or to invest in the real economy. And for those reasons, basically, can be assumed that investors get a excess return over cash through time. So then the question is, okay, so that's what risk premium is. And it could be in a 10-year bond. They call it term premium. It could be in an equity. They call that equity risk premium. But if you're comparing the equity risk premium to 10-year notes, there's a bond risk premium in there. But conceptually, every asset has some excess return over cash. And so then the question is the current excess return over cash a good deal? Meaning, okay, I'm going to take risk, but I'm going to get well rewarded for it. And the answer to that is no in almost every asset market in the United States right now and most around the globe. And so cash is more attractive than assets. And so why is that? It's because cash is now paying a very high interest rate. And so the question is, do you want to buy assets now because you think conditions are going to get even better for assets, meaning cash is going to become even more easier, or risk of assets, their volatility, et cetera, is going to fall? And I think the odds are that both of those things go badly, where both cash becomes tighter and portfolio volatilities, which are at very extreme lows right now, increase modestly. And both of those things would result in assets selling off relative to cash. And I think that's the world we're in.
That was a really helpful explainer. I want to return specifically to the yield curve. And when we had Michael Cowell on the program a couple of weeks ago, we talked actually about two things. One, Bear Steepner, Andy, which I saw you talking about on Twitter, but also an interesting observation that he made in the difference between the 2-10 spread in the US versus other developed economies. And as you both well know, the spread on 2s and 10s we've had a very inverted yield curve for a relatively long time. And I think that's caused some older market participants to be a little bit cautious. It is a predictor, not a perfect one, but a generally pretty good predictor of a recession. And I think what has even been a little bit more extreme in this particular case is that the Fed has been hiking into an inverted yield curve, which is pretty abnormal from my understanding of a Fed response. So, and what's interesting is that while the US yield curve is deeply negative, there are other developed countries out there that do not. They actually have a positive 2s and 10s yield curve. I don't know if you guys have any opinions on that. And then I'd just love to dive into your thoughts on the inversion of the yield curve and what a Bear Steepner could mean.
The thing when I look at other developed economies and I look at their yield curves, like the 2s, 10s part of it is not as interesting to me as where 2s are relative to target rates. And so you look at Europe and you see a circumstance where they're running 5 to 6% inflation. Their target rate, is 4, give or take, and the 2-year rate is priced in at 3. What's going on there? That's an inflation mandate, an inflation targeting central bank that is failing to meet its mandate, and not kind of failing to meet its mandate, brutally failing, desperately failing to meet its mandate. And what the market's pricing in is hundreds of basis points of cuts relatively shortly. And of course, you'd typically expect growth to weaken in response to the tightening, and you have seen some weakening in overall economic conditions in a place like Europe. But it's not enough. And I think that's really the challenge here as we scan across all these central banks. And really, basically all the central banks in the world have capitulated, right? They're all at pause or close to pause, right? That's basically how they've settled out what's going on at a time when in no major developed central bank has inflation fallen to their target. Certainly not in a way that has been long enough for them to believe that it's down there durably, right? And I think that's the very interesting tension point. So when I look at some of these other economies, particularly on the short end, I see a real gap between how low the 2-year point of the cycle is relative to the target rate, and see that gap suggesting that even if they hold flat for a while, right, which would be probably imprudent, but at least a reasonable path, a plausible path that they would pursue, even if a bit imprudent. That's going to get a lot of cuts priced out of those short end markets, and I think probably put pressure, necessarily on the longer parts of the curve, since the short end is in the long end to some extent. And so I think that's kind of what's interesting to me, is this sort of big global central bank bet on pause at a time where I asked this question on Twitter a couple of days ago. It was basically is that going to be the bigger mistake of this cycle, right? Is the pause going to be the bigger mistake than the bet on transitory, right? Because it's the pause that could create entrenchment. And so that's, the markets are not reflecting even an extended pause, let alone the need to do more work to bring those inflation pressures down.
By and large, my thinking on Europe is that the underperformance of bonds relative to stocks is almost more extreme than it is anywhere else on the globe. Like bonds have just and for good reason, bonds were yielding zero. And so they had a lot of room to underperform. And I'm coming to a point where I think long-term bonds relative to European equities are probably a good buy. But I also think, to echo your point, that another decent idea is buying long-term bonds and selling two-year bonds. Because while we are not as inverted, we're more inverted in the US, perhaps we'll get quite a bit more inverted in the European markets. Now, the UK is a little narrower because it, until recently, was expecting lots and lots of hikes. But again, they've also sort of come in.
Yeah, that's come in mostly.
Yeah,
right?
yeah.
I mean, that's.
But Europe is, Germany is, could see some significant further inversion, in my opinion. But it may pivot around fives and leave tens fairly cheap. So I'm looking at that as an interesting play, particularly against a short in Euro stocks or DAX.
I like that trade there, the putting it against the stocks, because in many ways the bond market has reflected at least some meaningful repricing of the value of money that's necessary, the value of cash that's necessary in Europe to fight the inflationary pressures that they have. But stocks have not at all, right? Like we're basically at highs, right? Which is kind of incredible to think that that's how it's getting priced now. There's some global dynamics going on there too, because a lot of those companies are global in nature. But the gist of the point that you're saying, I think, is quite compelling, which is that, is that relative to bonds, it is less of a compelling story. I think one of the things, though, when I look at the European markets, and maybe really when I look at the UK market in particular, which again, UK stocks, very important to recognize, UK stocks are global in nature. They're not predominantly domestically oriented in the United Kingdom. But what I do see is meaningful differences in the pricing between U.S. stocks and a number of a number of those other economies. So if you look at like UK stocks, I had a tweet about this a couple days ago. You're looking at like earnings yields that are close to double what they are in the U.S. What does that imply? You have U.S. companies are global in nature. UK companies are mostly global in nature. Obviously, there's more tilting towards the US and US stocks, but you've got a pretty wild divergence there in terms of the pricing that's been a function of a number of different things, just people trend following US stocks, plus the dollar being strong, et cetera. But it's created like a pretty remarkable difference in the pricing across developed stock markets. And so, that we're just talking through a complicated set of trades, but this idea of, holding foreign stocks, and particularly like UK stocks and other places relative to US, seems pretty interesting in this environment.
Yeah, I haven't thought of that one. That's a good one. I'm going to take a look at that.
Good. That's the whole point, Andy. Give you a few trades.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later.
The interesting thing about the U.S., let's come back to the steepener in the U.S. And I think you have to start with this idea of what is the Fed trying to do in terms of raising interest rates? Remember, prior to QE and QT, when they didn't use their balance sheet as readily, all they did was shift the front end of the yield curve, the short rate. But their goal was no one finances, or minimal number of people finance at the short rate. What they finance at is the sort of longer term rate where mortgages are, et cetera. Long-term corporate bonds, some obviously finance floating, but most of the U.S. finances in the longer-term rates. And so what their goal was to raise short-term rates, which would then make it difficult for an investor in a bond to desire to own bonds relative to what cash was yielding, and that would cause a re-steepening of the yield curve, or bear steepener of the yield curve. And that was the way it worked. And I still think they want that and still are pulling on that lever to raise rates so that the back end will ultimately tighten financial conditions. But they've been, and quantitative tightening is another example of that. But all of that depends on there being supply of long-term bonds. It means someone needs to want to borrow money. If no one wants to borrow money, long-term interest rates aren't going to rise. So you have to look at who needs to borrow money. The consumer doesn't, particularly the homeowner, because they have the greatest loan they've ever seen and probably will ever see in their home. And corporates, particularly the high-grade corporates, either have cash, like some of the Magnificent Seven, or are financed for term at very attractive rates. Banks, they should pass through their short-term interest costs to their depositors, and in some way they are, but mostly they're stealing from depositors, and so their financing is pretty damn cheap too. And so that nobody needs to borrow. But then 9 months ago, the debt ceiling came on, and the government said, you can't borrow. The government can't borrow anymore. So they aren't borrowing. And so shockingly, the yield curve inverted even further as the Fed kept raising rates and no one wanted to borrow. So rates in the long end didn't transmit what the Fed wanted them to transmit. And not surprising, the economy and certain asset markets rallied when there is no borrowing needed. Interest rates are staying low. Everyone has cash. And so we saw what we saw while the debt ceiling was in place. And then even in May, when the Treasury decided to refill their checking account, the TGA, they decided to use bills, which there's plenty of demand for bills, like $3 trillion, $2.2 trillion at the time in the RRP. And so those, we'll take all the bills you want. We don't need this RRP thing. But all that changed. And it changed on July 31st when the government said, hey, our deficit's getting a lot worse than we expected. We're going to issue 250 billion more bonds between now and the end of the third quarter. And we're going to issue to make it 1 trillion in total for the third quarter. And then surprising everybody, including me, who had the most bearish forecast in terms of issuance, issuing $850 billion in new money in Q4. And that shifted the winds. Now there's a borrower. There's a borrower who wants our money, and they want it because they want to pay off the Fed, who is doing QT. And that money has to be financed by the private sector. And that's putting a headwind on assets that I think will cause a long-term, it won't happen it's happened recently, but it won't happen fully until that issuance actually comes to market. And it's beginning. We'll have huge auctions next week in 3s, 10s, and 30s. And every other week, for as long as I can forecast, we're going to have a boatload of new long-term borrowing to put pressure on long-term interest rates.
I totally agree with Andy, and Andy's been all over this, like better than basically anybody in terms of what this shift in government borrowing dynamic will have, how the impact it'll have on the long end. I'd also add, it wasn't just, the government wasn't just depressed in its borrowing. Corporations were depressed in their borrowing, and households were depressed in their borrowing. And households don't really need to go out and borrow, given the fact that, like the magnitude of housing activity is relatively modest. But corporations do need to go borrow, right? Like, you can't have an environment where corporates basically don't issue any bonds, right, and don't engage in any borrowing for extended periods of time. And so what you actually saw, what you saw as interest rates rose and then became even more acute after the SVB circumstance, was that a lot of corporates came out of the bond market, basically no issuance in long end, just basically did nothing for like 6 months. Maybe overstating this a little bit, but it was very low. It was secularly low corporate borrowing. And that just couldn't persist. I mean, think about it. You've got plenty of companies that have, debt that's coming due that needs to refinance. They obviously don't want to do that as much as they possibly can, but at some point they've got to come to the market. And so it's been interesting to see, we're starting to get that bleed of corporate borrowing back into the market as well. And so if you put those two things together, that is, a real challenge, right? In terms of the amount of duration supply that's coming into the market. And it's also a reflexive challenge, which is if interest rates stay low and mortgage borrowing picks up, then that'll raise the demand for borrowing, which will raise interest rates, which will create a lid on the ability to borrow mortgages, or the desire to borrow in the future. And so you've got basically like, you had this sort of like perfect Goldilocks moment for like 9 months of the year or 8 months of the year when it came to the long end. And that is now over. And that's just such an important thing to recognize in terms of how this market is changing on a forward-looking basis.
Even just hearing those numbers, Andy, out of your mouth, I mean, $1 trillion in Q3, $850 billion Q4. I mean, the CBO, I think they came out with their first projection 10 years into the future, projecting a $2 trillion deficit per year. It kept getting revised up. I think the original numbers were 1.8, then it was 2 trillion a year. I mean, this run rate is pretty incredible, right? So to your point, you could certainly see this sort of negative feedback loop kick in, bringing more long-term bonds onto the market. Then you get your bear steepener. So maybe the recession that we opened the show talking about that didn't come, maybe it was some sort of combination of expectations and things that were baked into the market. Or maybe, frankly, it was just the amount of stimulus and sort of the borrowing dynamics that took place earlier this year. But you could certainly start to see that reverse. And then what I haven't asked you guys about is inflation. And it does not escape me that if you go back 1940s or 70s, whatever your preferred analogy is for inflation, the common dynamic that happened between the 40s and the 70s is it was stop-start, right? There were periods of high inflation where it accelerated, then it looked like we got back to target, and then it would kick back up again. So to your point, it does seem like the market is pricing in what the Fed is saying is going to happen with inflation, which is we're going to get back to our 2% target soon. But, when you combine this unbelievable amount of borrowing from the US government and the possibility of inflation returning, I mean, how do you guys forecast out what happens if both of those things end up combining in the wrong way?
Yeah, let me address the borrowing and the budget because I think it's important to recognize that it's my strong view, and maybe it's 10, maybe it's 50 years that it'll last, that when the U.S. wants to have a budget deficit, they can. That literally the money that they borrow, they spend and hand it to the private economy, and so it self-finances. Now, the clearing price is another matter, but I think in the near term, the focus on the $2 trillion, my number's 1.6 trillion. I think there's going to be a bit of a standoff in October, and they'll grab some, there'll be some concessions on the budget. And I'm going at 1.6 trillion. That's my rough number. But that's not important. What's important is the money that is borrowed from the private sector. Now, it'll be 1.6 trillion, but that money will be spent in the private sector, so there's no money destruction. The money will get destroyed in two ways. One is that the quantitative tightening, the $720 billion of Treasury runoff from the Fed's balance sheet, will require $720 billion of investment from the private sector, which will squeeze out asset markets. So that's the important number, the 720. Assuming QT keeps going, which I think it has to deal with the inflation question you mentioned, that's the pressure, not the 2 trillion or the 1.6 trillion. It's the extra 720 that the private sector has to assume. And then there's the Treasury General account, which should peak at the end of December. And as long as it stays steady, that doesn't require any more private sector financing. So I'm focused on that number, but 720 billion is a lot for the private sector to absorb, particularly given the other supply issues, which could include currency defenders and who own our bonds, and will almost certainly include U.S. banks who still have to either meet new regulations, have to issue long-term treasury, long-term corporates, or need to pair their balance sheet of long-term bonds. So that's the big pressure. Let me just hit on inflation briefly. We've got strong labor market. That's got to get hit. There's no other way to really kill inflation without some pain in the labor market. And we're seeing minimal pain. And then the other thing I think is important is to sop up some of the money that was created with the $6 trillion of fiscal stimulus during COVID that's still sloshing around our system, largely, by the way, in corporates' hands. And if they either keep it in their hands or they spend it on assets or they lose to labor and start paying it out in wages, but that money sloshing around is bad for inflation. It's going to be a support higher inflation. And so quantitative tightening should be increased to sop up some of that liquidity. And so without those two things happening, without a significant labor decline and the continued sucking out of this excess liquidity, cash circulating around the system, I think inflation is going to be tough to kill.
Yeah, and I think that's what the inflation part. I think is something that there's too much focus on, like, the reported number. There's a reported inflation number, and everyone is like laser focused on like what is exactly going to happen with like medical insurance, CPI in September versus October, and all this sort of stuff. Which like those of us nerds on FinTwit do find ourselves down that rabbit hole every once in a while, just so that we understand what's going on. But I think, like, taking a step back, super important to come back to the what drives inflation. Like what actually drives inflation, which is the amount of nominal spending relative to the amount of nominal production in the economy, sets the clearing price of prices, right? That's how inflation works. And so it's not just like some academic curve that is the reason why, you have to get wages down and labor market weakening in order to moderate inflation. It is like a common sense, intuitive rationale, which is that if you're paying people, the growth of their income is growing at 5 or 6% a year, and the growth of their production is 0 per year, like that leads to higher prices. It just like mechanically has to lead to higher prices. And that is basically where we are in the US. And also importantly, where we are in Europe and in the UK, where we have essentially 0 productivity growth in the in all of these economies for a variety of different reasons. But that's basically where we're at. And we have elevated nominal income growth. and elevated nominal spending growth. And so until you start to resolve that problem, right? And productivity doesn't get resolved like in a day, like maybe over 10 years or 20 years, or maybe AI will change.
AI.
We'll have our avatars doing this speech, doing this conversation 5 or 10 years from now. But until that happens, you still have the productivity of us sitting here having a conversation. And that won't change that much. And so you can't change that lever. You have to change the wage lever. And the way wages come down, we know, is through weakening employment. That's a very intuitive understanding of what drives wages. It's not some academic exercise.
It's or anything like that. Right. It's just
right. It's just a common sense exercise. And that's the basic problem. And that's why, if we tie it back to that pausing point that I was saying, which is like, it's not just that measured inflation is too elevated relative to these mandates. It's the structural inflation, right? The structural drivers of inflation across the developed world are still elevated relative to the mandates. And central banks, and meaningfully elevated. This isn't like a tweak between 2 and 3. This is meaningfully elevated. And central banks are giving up. They're stopping on expectation that they've done enough. That's a hell of a bet when you see what the structural inflationary pressures are in these economies.
So if I'm understanding correctly, Bob, the worry is that structural inflation is still here. We're not George Bush standing and saying mission accomplished yet, right? That's quite an image. But yeah, so there's still a lot of work to be done. And the pause actually might end up being an enormous mistake. And, at least the way that I look at the economy today is we've got our work cut out for us, even assuming that the inflation beast is tamed. Can you walk us through, let's just say, obviously none of us have crystal balls here, but let's just say there's a situation where inflation starts to take off for any number of reasons, right? Maybe it's energy prices, something like that. But it really starts to take off again. Then put yourselves in the shoes of the Fed. I mean, what do they do in that scenario, right? Because a lot of their posturing and Powell's, how he's addressed folks at the FOMC over the last couple of months is, we're going to have to do what we have to do, but the markets have been pricing in cuts, sort of beginning half of the coming year. That, to me, we haven't really talked about the possibility of an impending credit event, but I think in the case where inflation starts to take off, the Fed is forced to actually get much more hawkish than the market expects. I think that is the time where you could see a credit event occur at the same time that inflation starts to take off. And then if you're the Fed, you're just in a pretty tough pickle. I mean, am I outlining a scenario which is totally out of the realms of possibility, or how do you think about what I just sort of laid out there?
I think it's certainly a plausible scenario where the Fed pauses, where other inflationary pressure, the structural inflation doesn't get resolved, other inflationary pressures emerge, maybe they're exogenous in nature, which creates a reacceleration of measured inflation, et cetera. And that will create a problem. That'll create a problem, which, central banks will have to respond with more tightening or longer pausing or whatever it is, higher rates relative to what's priced into these economies. And that, I think relative to what's priced in today, I think it's very important to say relative to what's priced in today. What's priced in today is that they'll cut. And what we're saying is they probably need to pause and there's some risk to the upside. That's, I think, the nature of the interesting trade in the sort of 2-year space. More interesting in Europe. Most interesting, I think, actually in Europe, but also somewhat interesting in the US and the UK. The credit event point, I think, a lot of people, when you talk to them, they say, well, look, if interest rates keep rising, let's just say, regardless of this inflation pressure, just long rates keep rising.
Sure.
That something will happen. There will be a credit event, right, of some sort. Well, first of all, what I'd emphasize is first the rates rise, then a credit event happens, then rates fall. Right. And so that's the ordering matters a lot. Right. So if you are buying, unless you think that a credit event is emerging like today, which to be clear, we don't see it. Where's the credit event? Right. Unless you're seeing a credit event today, right? Bonds will have to rise before we get into that environment. The second thing I'd say is look, part of the central banks dragging their feet has been part of the benefit, let's say the benefit of central banks dragging their feet and not aggressively tightening is that a lot of financial intermediaries either proactively or at the response of their regulators have gone through an effort to reevaluate their duration risk to start to minimize those credit risks or their interest rate sensitivity. I put something out a couple of weeks ago, which is when we had that sort of meaningful rise in rates, and you actually saw no relationship with the KRE. Interesting, right? If these banks were really had big bond risks, you'd expect the KRE to get crushed in response to rising rates. Not true. And then when you went under the hood, actually, it's not like there was a tail that was largely hedged and a tail that was highly sensitive. Essentially, no banks were sensitive to the rise in rates. And you don't want to create your bets on those banks using market information. But if you're trading the macro economy, you're trying to understand, is there going to be a broad credit event? Like, there's no better lens to see that than the intermarket action between those things. And so what you're seeing is that I think it's a very good indication of how, there was a scare. The regulators came in and the people and the entities proactively came in and said, we got to cut the duration risk. We are cutting the duration risk. They've done that. We know there's like great stories in the FT about how the Bank of England did that in the UK and basically have made these entities resilient, meaningfully more resilient to a path of rising rates. And so I think like the ordering plus the improved resilience over the course of the last 12 to 18 months puts us in a position where, sure, if rates are 10%, there will be credit events. But rates at 450, 475, 5, anything that we, are plausibly going to be looking at anytime soon, we're not going to have it.
Yeah. LDI, SVB, man, I've lived through these things. I've sat at Solomon Brothers when the Treasury bond auction scandal happened. I saw when a regulator comes in and sort of makes you do stuff. I've lived through Drexel Burnham going out of business. These and what that did to the high yield market, what it did to, what the savings and loan unwind is, what long-term capital did during and that whole unwind. These institutions in Europe, in the UK, and the United States have had a hell of a couple of months. Every one of them has a regulator on site every day. Things change. None of these regulators are going to get caught with their pants down on a single institution in this country. Now, there might be some single institutions that are in trouble. There always are. But, this whole credit event thing is going to require a lot more pain. Nothing like 4.5% unemployment rate and 5% Treasury bond yields will unlock a credit event, given the number of barn doors that have been closed in the last 6 months. So, yeah, it's a risk. So let's get back to your bigger question, which is forget the credit event. Can we see a pause result in higher interest, a reacceleration of inflation? Of course we can. Will the response be to hike again? Probably. What would I think would be the way to durably kill inflation? Targeting the right thing, which is employment, amount of money in the system, and wealth effect asset prices. And the way to do that is to cause the longer end of the curve to bear steepen. Without that, it's just going to take a long, long time if all you're doing is waiting for borrowers to come to market, to raise interest rates, to slow the economy. So I think that's the response. You'll have a forward guidance, which will look like we're pausing forever, and you'll have more QT.
And I think that's one of the things, like, I guess I don't quite know how long the Fed and these other central banks will accept not getting clearly back to where they're going before they start to get themselves back into gear here. Like, if you go back and you look at other inflationary cycles, like the path that we're seeing right now is actually pretty usual in the sense of inflation emerges after a period of low inflation. Central banks are behind the curve because, they're not used to it. They respond with some tightening. It looks like things are getting better. Then they kind of like let up a little bit, and then things start to emerge again. And, it usually takes like 3 or 4 waves of what I just described in order to get the like, okay, forget it. Like we are tightening seriously, and, unemployment rate be damned. We're going to bring this inflation down because, it takes time for it to just feel so problematic for everyone in the economy that everyone sort of coalesces around that view. Now, it took, arguably like 15 years in the 60s and 70s cycle. Like, is it going to take that long here? Right. Or will they move more aggressively? I don't know. Like, that's kind of like, that's kind of like, if I had a crystal ball and could understand one thing, it would be like what would be their reaction function to renewed inflation, how fast, et cetera. And I can't quite figure out whether it's hawkishness and the lessons learned and all that stuff is real, or is it just like talking points, on a sheet of paper. Andy, I don't know if you have any thoughts on that.
Yeah, I certainly don't know. I think I know what levers they have to pull to make it work. And those are the ones I stated.
Yeah.
That's a tricky question. The Fed has never had a difficult time hiking rates during and being tighter during elections. That's a myth that they stay out of the market during elections. In fact, 8 out of the last 13 presidential elections, they've hiked. But I'm not a tin hat at all, and politics is a game that I find to be mostly noise. Policy maybe, but politics no. The choice to use runoff instead of UK style outright sales for quantitative tightening handed the tightening impact, as we saw in the last 9 months, to the Secretary of the Treasury. And so she can spend down the TGA for political reasons. She can issue more bonds to slow the economy. She holds the QT policy lever, and that's unpredictable, let me just say. Because her interests are not aligned directly with the Fed's interest and mandate. And yet she holds in my view, their currently most powerful lever. I think predicting firstly, it's hard enough to predict whether inflation will come back. I think structurally I'm in agreement, and I think we're going to see a higher inflation print relatively soon this year. So I guess I'd have to wait and see what it looks like. I think I understand what assets to own when I look at it, and what assets to be short for such a thing, and see what they do.
Yeah, and I think that's kind of like the I certainly didn't mean to like put you on the spot there, Andy. This is an unknowable question in some ways, but I think it is. It's a cruxy question because maybe less for who knows, it's hard enough to predict the next 3 months. Like if we're talking about the next 10 years, our alpha decays very rapidly between 3 months and 10 years out. But I do think for strategic asset allocations, for people who aren't betting, in the markets every day and betting every day, that question is sort of a critical question that I think most are not really wrestling with. Because if you were wrestling with that and you thought even if it was a 20% probability or a 30% probability, you'd start preparing for that dynamic, right? You'd have to start preparing by holding the assets that you think make sense to hold if they choose the path of pausing and waiting too long and reaccelerating and being a little too soft and that sort of dynamic. And I think basically we talk about tactically the markets being all in on soft or no landing, like combine that with like strategic asset allocations for many folks that are essentially all in on a perfect return to 2% inflation forever. And like, both are very over their skis on how this is like how this can play out relative to what's priced in. So anyway, that's part of what's on my mind when I'm thinking about that question. Is more a strategic question, allocation question than a tactical one.
Right. And so that, we're going to say the same thing, which is combination of higher allocation to cash than you are normally exposed to, lower allocation to 60-40, higher allocation to commodities and probably gold and maybe crypto if that's going to work. You're welcome. Possibly adding on top of that some absolute return strategies that are uncorrelated, like hedge fund alpha strategies, could be any form of thing that is uncorrelated to the portfolio. Seems to me to be the long-term tactical best fit at this stage.
I was listening to a great interview on Invest Like the Best with Lee Ainsley of Maverick Capital, which I highly recommend. Invest Like the Best it was one of the podcasts that made me fall in love with podcasts. But he was describing hedge funds, actually, especially the sort of market neutral long short guys, not doing so hot over this past year. Hedge funds, I don't have much insight into how hedge funds actually have performed. I mean, can you kind of, just as both of you guys have the background at Bridgewater, can you just kind of walk us through how have hedge funds done the last couple of years? Like how are institutions thinking about them as a bucket?
Let me give you my personal experience running a hedge fund that was market neutral. Mm-hmm. Most aren't. Most are
directional bias in there.
Most think they are, and some cheat. Right? Some always are long, and they claim they're market neutral, but know they're beta long. And then others, like the ones I was part of, and ones that like Long-Term Capital is a good example, think they are truly market neutral. And what I've found in year after year after year of data of market neutral hedge funds is market neutral hedge funds are long. Yeah, I'm in that book. Are long. And I'm not one of the geniuses. Are long illiquid assets hedged with shorts in liquid assets, and so they may be market neutral, but they are not deleveraging neutral. And so in periods of time when market neutral hedge funds are experiencing a deleveraging environment, they're going to underperform because that's their principal risk. They are levered relative value. And when that delevers, when they lose their ability or the cost of their leverage increases, they get killed. And so 98, 94, 89, 2001, and obviously the mother of all is 2007, 2008. Some of these mortgage arbitrage trades were market neutral, but they weren't liquidity and they weren't leverage neutral. So I can't speak to whether hedge funds, I bring that story up because I've experienced being in a position where I was market neutral and still lost money because of this deleveraging thing that, by the way, only happens when markets go down. So it creates a correlation to beta at the worst possible time to be correlated to beta. You have your drawdown as a market neutral fund when everybody's losing money. You can't have that. So I think that's broadly the experience over the past few decades. And it just speaks to real alpha, real structural, unbiased to every factor that is part of long beta, so that you really have a structurally uncorrelated alpha. And I just think that's very, very rare in this industry.
Yeah, and I'd add March 2023 also in your litany of different dynamics as well, which is essentially the same thing effectively happened across the hedge fund industry. I'd add I think Andy describes the dynamics really well in terms of how these things work. There's also a positioning thing. People may or may not know this. Like my day job essentially is to build hedge fund replication strategies, right? So, I'm very close. Hedge funds have basically performed, very modestly in over the course of the year, in low single digit type performance. And I think part of it was that the March 2023 period was a particularly challenging period for them because you had essentially, like if you think about the macroeconomic environment and the dynamics, the sort of, let's call it the trend in the underlying dynamics, not the trend in asset prices, but the trend in underlying dynamics, you had basically a higher for longer scenario that became a deflationary depression in 24 hours. And, like that is a very, that can happen. But it is a very hard environment from an alpha trader's perspective, because you're either dead wrong going into it or dead wrong on the backside of it. And so that was a hindrance to alpha traders relative to those people who were long only through the whole period. And it forced a deleveraging at the worst possible time, as Andy describes. And then on top of it, I think, hedge fund managers in general have been more conservatively positioned than essentially index investing, seeing the overall set of dynamics here. And when I say more conservatively positioned, I mean taking less equity risk, taking less credit risk, seeing this overall dynamic for many of the reasons that we've described over the course of the year, why you might think that there's more risks to the downside. And so like, it's an interesting thing. Go around and ask who the heck has done better than the S&P 500 or NASDAQ this year. And if you talk amongst professional asset managers, the answer is literally no one, right? Because literally everyone has seen what's going on and has said, oh, we need to be more conservative amongst the professional manager set, amongst advisors, right? Many advisors have been more conservative than going all in on stocks. And so kind of, who's winning in this situation? It's people who basically were levered up on asset prices, people who were, long only index investors have done very well. And basically many professional managers have underperformed as a result.
If they survived the drawdown in March.
If they survive yes, you're saying the long only, the levered long only.
Yeah. I mean,
if they survive,
that was a pretty big drawdown.
No, it was a very tough environment. And so, I think the hedge fund industry, and it's a little bit hard, hedge fund managers' individual performance is like incredibly variant, like unbelievable, like the cone is between, 30% below the benchmark to 30% above, right? Like that's kind of the variance of an individual managers, but the industry as a whole, is not, if you sort of take that sort of approach, the industry as a whole is not one that goes, takes big yo's on, late cycle environments to go all in on equities, right? They prudently maintain, preserve capital during challenging market environments. This is a challenging market environment. They're mostly preserving capital in order to ensure that, they continue to play the game in the future. And when there's more clear trends or more clear, obvious alpha opportunities, they tend to do better in that environment. Plus, when there's a little bit of beta out, performance as well. And so, this is what you're getting is often hedge funds will be kind of, mediocre performers for 6, 12, 18 months relative to index investing, even though over time, over a 20 or 25 year time frame, hedge funds are a good bet relative to traditional index investing, given their approach.
Yeah. I was just curious. I've read, I went on I've got on my bookshelf here, I've got various When Genius Failed or The Man Who Mastered the Markets. And I just find it super interesting to, people have very different approaches even within hedge funds, right? So I was just curious about how the asset class was performing. Guys, you've been both super generous with your time, and I know we've gone a little bit over. So I just want, if folks want to maybe find out a little bit more about your work, Bob, you were just getting into some of the work that you do at Unlimited, or just follow you, or whatever it is, what's the best way for them to find out more?
For me, you can follow my Macro Takes Live, pretty active Twitter on @BobbyUnlimited. I also have an emerging YouTube set of work under the same handle, which I'm working on. So definitely check me out there. If you want to understand what we're doing at Unlimited, see whether these sorts of strategies are could make sense for your portfolio or your clients' portfolios, you can check out what we're doing at unlimitedetfs.com.
And for me, I'm at Damp Spring. I also am at dampspring.com. And a partner, Nick Giovanich, and I have a site called Two Graybeards, hence at least one of the Graybeards, where we help investors with a 20-minute weekly video on how to have better conversations with your financial advisor who you're paying, $50,000 a year to keep you in 60/40.
To take you golfing.
Right, and take you golfing. So at Two Graybeards on Twitter or twograybeards.com and Damp Spring and dampspring.com.
Andy, can you give us I've looked at your Twitter handle before. What's the history of Damp Spring? That's a little alpha for the listeners.
So I'm an engineer by training, and a damped spring is a model for markets that I have been working on for my whole career. And it really describes a damped spring for you is a shock absorber with a spring on a automobile. And so if you think about markets and how we go from one equilibrium to another, how we hit a bump and how we either spring back and forth down the road or we smooth out that through artificial external stabilizers. It's been how I've thought about markets really because I'm an engineer and it's the most basic physical construct that you can know about when you study physics. It's always stuck with me.
Well, I guess I just outed myself as not knowing shit about physics, but I'm asking what that is. Well, congratulate guys. I really appreciate you both coming on the podcast. This was a really fun one for me. The duo, you make a formidable duo, so we'll have to do it again sometime soon.
Anytime.
Awesome. Right. Thanks so much for having us.